Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Swire Properties Limited annual report. Swire Properties Limited offers a diverse range of businesses and services across various sectors. At the core of its operations are property development, ownership, and management. The company develops mixed-use properties, primarily commercial in nature, in Hong Kong, mainland China, and the United States. In terms of specific services, Swire Properties engages in leasing and managing commercial, retail, and residential properties. This includes developing and selling residential apartments, indicating a focus on both property development and sales. Furthermore, the company invests in and operates hotels, providing a hospitality service to its clients. Beyond these core activities, Swire Properties also offers additional services. These include financial services, such as investment opportunities, and real estate agency services, which cater to the needs of property buyers and sellers. This comprehensive range of businesses positions Swire Properties as a significant player in the global property market. Swire Properties' stock price has seen a remarkable surge of 61.29% in the past year, driven by a combination of strong financial performance and strategic growth initiatives. The company's first half 2025 results showed a 15% increase in underlying profit to $4,420 million, fueled by successful capital recycling and resilient rental income. A key factor contributing to this success was the disposal of assets, including the Brickell City Center retail mall in Miami, which generated significant profits. This capital recycling strategy has bolstered Swire Properties' financial strength, enabling it to reinvest in high-growth opportunities across its core markets. The company's expansion efforts in mainland China have also been a major driver of growth. Large-scale mixed-use developments in Shanghai, Beijing, Sanya, Xi'an, and Guangzhou are progressing well, with the aim of doubling gross floor area by 2032. The Lujiazui Taikoo Yuan residential project in Shanghai has seen exceptional market response and strong sales momentum. In addition to these growth initiatives, Swire Properties' Hong Kong portfolio has maintained high occupancy rates, benefiting from a flight-to-quality trend. The company's commitment to shareholder returns is also evident through consistent dividend growth, with the full-year dividend for 2025 raised by 5% to $15.15. The cumulative effect of these positive developments has propelled Swire Properties' underlying profit to a 27% surge in 2025, reaching $0.62 billion. With analysts predicting a gradual recovery in Hong Kong's residential market, the company's stock price is expected to continue its upward trend. Swire Properties Limited market capitalization of $141 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Swire Properties Limited holds a significant advantage in their industry. Swire Properties Limited trades at a lower price-to-book ratio of 0.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 4.54%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the disposal of non-core assets such as the Brickell City Center retail mall and car parking spaces in Miami contributed significantly to revenue growth. Additionally, increased leasing inquiries in Pacific Place and strong placemaking achievements at Taikoo Place also boosted revenue. The company's focus on improving its tenant mix and enhancing its brand positioning has led to a surge in footfall and sales at its flagship malls. The introduction of visa-free entry to the Chinese mainland and value-added tax refund schemes for international tourists have further contributed to revenue growth. Furthermore, the successful redevelopment of investment properties and the sale of office floors at One Island East have also generated significant revenue. In terms of residential markets, the company has seen a strong demand for luxury living in Southeast Asia, with many of its developments experiencing high sales rates. The handover of units to purchasers commenced in June 2025 at LA Montiagini, and both houses sold at 6 Deepwater Bay Road in December 2025. On the other hand, the primary drivers of revenue decline can be attributed to several factors. Firstly, the loss of rental income following the disposal of Brickell City Center shopping mall in Miami has had a significant impact on revenue. Additionally, lower office rental income in Hong Kong due to high vacancy levels and pressure on rents from new supply has also contributed to revenue decline. The impairment charged on trade receivables decreased by $29 million, while depreciation of property, plant, and equipment increased by $59 million. Amortization of intangible assets decreased by $15 million, and staff costs increased by $59 million. These factors have all contributed to a decline in revenue for the company. The company is indeed generating positive operating cash flow. This can be seen in the various financial metrics presented on different pages of the report. On page 51, it is stated that the operating cash flow for 2025 was $23,119 million and $20,419 million for 2024. These figures indicate a significant increase in operating cash flow from one year to the next, further solidifying the company's ability to generate positive cash flow. Furthermore, on page 52, it is mentioned that net cash from operating activities was $7,471, 2025, and $3,762, 2024. This also shows a substantial increase in net cash generated from operating activities, reinforcing the notion that the company is producing positive operating cash flow. Additionally, on page 3, it is noted that cash generated from operations for 2025 was $10,024. Although this figure is not specified for 2024, it still indicates a positive trend in the company's ability to generate cash from its core business activities. In conclusion, based on these various metrics, it is clear that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes. On one hand, the net debt has decreased by 10%, indicating a reduction in overall debt. However, the total debt has increased by 26%, which may seem contradictory, but can be attributed to the company's strategic borrowing decisions. A closer look at the breakdown of debt by maturity reveals that while short-term debt has increased, long-term debt has decreased. The weighted average term of debt has also increased from 2.5 years to 3.3 years, indicating a shift towards longer-term borrowing. This change may have implications for interest expenses in the future. Despite these changes, interest expenses have actually decreased by 17 HK$M -1%, suggesting that the company's efforts to manage its debt have been successful so far. Overall, while there are mixed signals regarding the company's debt level and interest expenses, it is clear that the company has made significant efforts to optimize its borrowing strategy. Management's commitment to delivering sustainable growth in dividends remains unwavering. The company aims to pay out approximately half of its underlying profit in ordinary dividends, with a target of mid-single-digit annual growth. This strategy is expected to drive long-term value for shareholders. The $100 billion investment plan is a key component of the company's growth strategy, reshaping its presence across its three core markets. Management expects this investment to yield benefits from shifting consumer behavior, a robust calendar of international events, and improving inbound tourism activity in Hong Kong. Over the next decade, the company will invest $10 billion annually to drive growth through development projects in Hong Kong and China. The company has made significant acquisitions and divestitures over the years. In terms of acquisitions, the company has purchased various businesses and investments, including Lion Dining Group, OCBC, Rednote, China State Construction, Euler Technology, Right Capital, Software One, Watt New Media, General Atlantic, Kingland Law, a minority interest in Empire City in Vietnam, and a 40% stake in a site on Wireless Road in Thailand. These acquisitions demonstrate the company's expansion into new markets and industries. The divestitures, on the other hand, show that the company has been actively selling off non-core assets to focus on its core business. Some of the notable divestitures include the sale of Brickell City Center shopping mall in Miami, a retail investment portfolio in Miami, certain residential units in Hong Kong, and a site in Brickell, Miami. These sales suggest that the company is streamlining its operations and reducing its exposure to non-core assets. The company has a history of paying dividends to its shareholders. In fact, it has been consistent in this practice, with the most recent payment being for the year 2025. The total amount paid out was a significant $6,401 million. In addition to the full-year dividend, the company also pays interim dividends on a regular basis. For the current period, the interim dividend per share was HK$0.35 and HK$0.80. This brings the total full-year dividend to HK$15 per share. That concludes the financial summary for Swire Properties Limited. Feel free to comment below, and I will be happy to answer them when possible.